The United States versus Russia and its group of petroleum exporting countries, the battle of who controls the global market, reaches a sensitive stage. Its consequences will destroy our financial system. Last week, in a single day alone, oil prices soared by more than 6% and continued to rise amid fears of falling inflation and tightening economic conditions.
You know, I guess if I were angry at the Saudis and OPEC cutting back production 2 million barrels a day and driving up oil and gasoline prices, I don't know that I would end all offshore leasing and drilling and permitting, but that is on the table. And I wanted to get your take. What does that mean? No Gulf of Mexico, no nothing? How's that going to help?
Yeah, this is a really scary time, I think, geopolitically, of course. We're in the worst energy crisis that the United States has seen since the 1970s. And we have an administration right now that is actually considering cutting off development of 16%.
Western countries, including the United States, tried to control the oil market by controlling oil prices and putting pressure on oil producers and OPEC members. However, every action has a reaction that matches or exceeds it in power and effectiveness. In this video, we will reveal the reasons why OPEC countries have decided to cut oil production these days. But before moving on, don't forget to subscribe to Financial Countdown and ring the bell to be notified when new content comes out.
In a surprise move, the Organization of the Petroleum Exporting Countries has announced major cuts in production. The move has jolted the international market and sent oil prices soaring. This is the second time that the major oil-producing countries have announced production cuts in less than a year. The company made the announcement on Sunday. It said that it will be cutting oil production by more than 1 million barrels per day. The organization, led by Saudi Arabia, has called this a precautionary move aimed at stabilizing the market.
Western countries led by Russia took that as an insult and responded by cutting their daily oil production. Up until now, there have been several oil output cuts totaling 3.66 million barrels, and the recent one equals about a third of the total numbers, which, to be accurate, equals 1.16% million barrels a day. With that huge number, we can only imagine how this could affect the global oil supply and demand as well. But why did this group suddenly decide to do this massive oil cut? But since the United States markets and oil demand have weakened, this has provided a good opportunity for other players to control the market. This is the main reason.
This has in turn fueled inflation across the world. Countries from the US to European Union are already facing the brunt of rising cost of living. The situation is even worse in countries like Pakistan and Sri Lanka, which are struggling to rebuild their collapsed economies. Now, with oil prices bound to rise further, the cost of living crisis is set to get worse. Today, the 13 member nations of OPEC, along with 11 non-allied members, are expected to hold a meeting of the Joint Ministerial Monitoring Committee. The move by the Saudi-led grouping is also an indication of an evolving world order where the US has little say in the affairs.
The other reason is to bring oil prices back to their usual level of the past 3 months. The banking crisis and its results were the main reason for the fast decline in crude oil prices to a level of $70 per barrel.
Well, yes, we have seen the crude oil prices decline down by 2% overnight, and with that, we are down by 4% in this week and down 6% on the month as well. And the crude oil prices now are trading at a 3-month lows. The weakness in US dollar and the China demand recovery have been the supportive factors in last many sessions, but the collapse of Silicon Valley Bank has raised concerns about a broader financial and economic crisis, and that has triggered a sell-off in risk assets. Also, if you look at the EIA report that came in last evening, says that the US shale output will increase in April to the highest since December 2019. So supply is clearly not a concern, and markets still are looking at uneven, even fragile recoveries from China that continues to weigh onto the market. So we are trading below $80 for the Brent prices. We've seen 86 of a high in the month of March itself. So a very sharp cut coming in, with the markets now suggesting that another couple of dollars of a decline in this week now is not proved out.
On the one hand, oil price ups and downs left investors uncertain about the market. That forced them to ditch any risky assets, including commodities such as oil. However, even though it's a calculated move, it's a risky one as well. By cutting oil, the global market will feel the heat, especially in terms of supply and demand. Oil demand will rise in the next few days while its supply remains lower than the market needs. This will cause an increase in oil prices. Goldman Sachs says oil prices are expected to reach $95 per barrel by the end of December 2023.
There's many factors which are driving the oil outlook. Obviously, we've got Brent back at around 87, which is not too high. Our view is it's going to be between $85 and $95 a barrel this year. What would really push it over that would be not necessarily a huge spike in demand from China, because I think there's still an issue there about where the Russian oil is going, and that's not really making it to the main markets, but maybe going into China. And thinking about really the supply side, and if we saw further moves by those OPEC plus nations to try and keep that oil price around that $85 to $95 a barrel without letting it go too high. So the oil energy price outlook, obviously there's a risk to see it spike higher on some of this renewed confidence around that China demand story. I think we've got a ways to go before we might actually see that impact the market. And largely that's actually being reflected in today's prices. So unless we see an absolute surge in growth in China, which I think is still difficult in the 4 quarters ahead, given some of those structural limitations there, I don't think we'd expect to see the oil price move back over $100 a barrel this year.
Higher prices are not the only problem the global market might face. The sudden cut decision just complicated the Federal Reserve's job. There is a direct relationship between oil prices, mortgage rates, living costs, and manufacturing activities as well. High oil prices could lead to a significant increase in mortgage rates, living costs, and declining manufacturing activities. The Federal Reserve might be forced to raise its key interest rates to lower the rising tension caused by the increasing cost of living. That could work in normal conditions, but with the banking crisis, the central banks are being more cautious with their key interest rates. That's a great risk that these sudden oil cuts represent. By lowering oil production, these countries are causing another problem that could lead to a large financial crisis. A crisis that is larger than the one we had in 2008. Your opinion is very important to us. You can leave it in the comment box below this video. Thanks for watching.